Investors were really afraid as the market dropped throughout 2022. Now, if you can believe it or not, they're scared because the markets are recovering too nicely. Is this the definition of schizophrenia? Well, let's take a look. The definition of schizophrenia: a serious mental condition involving a breakdown in the relationship between thought, emotion, and behavior, leading to faulty perception, inappropriate actions and feelings, withdrawal from reality and personal relationships into fantasy and delusion. I think that says it all. Does that describe the average investor? Well, maybe. Have you ever been in a situation where things just are too good to be true? Well, I think that's how Farzad is feeling, at least about Tesla. He recently tweeted, "The last time I felt this bullish about Tesla, the stock fell 70%. Now, I'm not saying Farzad's a schizophrenic. He's anything but. He's very analytical and logical in his approach to investing. But I think it kind of describes how just about everybody's starting to feel right now after a whole year of the markets dropping. Could it really be over? Is it really over? Well, let's take a look and find out. So as always, the first thing we're going to do is take a look at the market action over the past week, month, 6 months, a year, 5 years, whatever the time frames we decide to look at here, just to get a sense of what's going on in the markets. I think this gives you a kind of a good grounding and a basis on which to look forward. So let's take a look. Over the past week, you can see that ARK, the riskiest stocks, finished ahead of everything else, ahead of small caps, NASDAQ 100, a little bit less risky, ahead of the SPY, a little safer, and ahead of the Dow, safest. So this is a very healthy rally, even though these started to fall off in about the last day and a half. And what about over the last month? Well, you can see here, again, ARK finished way above all the rest with the highest return over the last month, followed by the NASDAQ 100, followed by small caps, followed by the S&P, followed by the Dow. Again, a very, very healthy looking market. And if we look back 6 months, what do we have? Well, you can see since the market bottom back here that the ARK Invest has been on a very steep slope upward. Now you can see how all of these fell off here in the last day and a half or so. But if you look back going to the recent bottom, these look very, very good. So here's the NASDAQ 100, not as much slope as ARK, as you can see here. Let's look at the S&P 500. S&P 500, a little bit less slope. And then we'll look at the Dow. I'm kind of skipping small caps here, but you get the idea. So if you look at the Dow, the least slope of all of them. So riskier, a little less risky, a little less risky, safe. This is the definition of a healthy rally coming off of a bottom. And what about if we look back over the past 5 years? Well, you can see that when things were good, ARK handily outperformed all of these. And in fact, if you want to see how long a rally can last, let's go back to the bottom of the pandemic back here in March of 2020, and let's look at the NASDAQ or the S&P. Let's look at the NASDAQ because it kind of sits out here by itself. But you can see it rallied from March of 2020 all the way to the end of 2021. That's a pretty good long run. And, I'm not saying that's going to happen right now in this very moment, but it could. So don't turn tail and run until you're really sure that things are falling apart again. So what are the equity bottom dynamics telling us right now? Well, not really much of anything. These metrics give us indications at or near the bottom. So you get typically a bottom forming indication, which is this orange line when it's way up here at the top, and you've got the confidence level near the top, followed by a bottom confirmation where the blue line's near the top, and the dashed line, the confidence level, is near the top. But right now, where are we? Well, right now, the bottom confirmation level is fairly high, and you want it to be up here while the market's rallying. And the bottom forming indicator is way down here, which is also where you want it to be when the market is rallying. But what's happening to the confidence level? The confidence level is moving higher. So if this confidence level continues to move higher, and this bottom forming indicator shoots up here, then we've got a problem. Then we're heading for a new bottom. But right now, we don't have that indication. Right now, things look pretty good. What about risk versus opportunity? Now, I showed this graph for the first time in my video last week, and I'll put a link to that video in the pinned comments below. But you can see here that the black line is the price of the S&P 500. The red line is the risk level. And by the way, these risk and opportunity levels are not calculated from the S&P 500. They're calculated from a lot of fairly complex information that's indicative of what the risk might be in the S&P 500 and other indices. But you can see what happened back here. We had a little peak here, and this risk level just shot up. And in fact, about the time it crosses 80 is the time you want to turn tail and run and get out of the way. And in fact, if you had done that here, you can see that the price of SPY fell further after that. Now, we use those bottom analysis indicators to determine where do we get in after this bottom. So you can't use these risk indicators to determine when to get back in. As you can see, this didn't fall below 80 until way over here. I guess you could, right? But you missed a lot of the run here. And certainly you can't use this opportunity level. This is a very late indicator, but you can see how it's shooting up very nicely here and showing that the markets are in a very healthy state right now. This looks great. What about equity versus safety rankings? Now, these give us a little bit of a different look into what's happening in the markets. And right now, today, as of last Friday, we have a very, very healthy looking equity and Treasury markets. Right now, as of this last Friday, February 3rd, we have very healthy equity markets and very healthy Treasury markets. You can see the highest risk equities, the NASDAQ 100 and small caps, ranked 1 and 2, followed by SPY. And then you can see that Treasuries are pretty much in order of duration, although I don't like the fact that cash is up here at number 4. Probably came up like that because of the big drop on Friday, but hopefully that will head down later next week. And gold went from being ranked right near the top. In fact, it was number 1 before January 13th. And you can see how gold has fallen right to the bottom of the heap. So how does this show up in the buying and selling pressure? Well, you can see here for the Dow, we've had kind of a tentative rally here and a big sell-off here. And in fact, I think this big sell-off was due to people who were in the Dow for safe reasons, selling that safety and putting their money in risk. And you'll see that in some of the riskier indices. So the Dow looks kind of tentative here. The buying pressure, this solid gray line, was above the selling pressure, and now it has fallen below the selling pressure. So the Dow's basically kind of tentative right now is what I would say about it. And what about the S&P 500? Well, this has been a little bit stronger of a rally than the Dow. You can see how it didn't drop off precipitously like the Dow did back here. And the buying pressure is well above the selling pressure, and the trends are all moving higher. This looks very healthy. What about the NASDAQ 100? Now, the NASDAQ 100, again, a very strong rally. The buying pressure well above the selling pressure. But what gives me a little bit of concern here is that the 1-month trend in the buying pressure is trending just a little bit downward while the price is moving upward. Let's see where this goes. If this starts to move higher into next week and the week after, that'll be a very strong indication. And the Russell 2000. Russell 2000, very healthy. Nice rally, buying pressure above the selling pressure, and 1-month trend still trending higher. And then what about Ark Innovation? Very strong rally here from less than $30 a share to over $42 a share in a very short period of time, a little over 1 month. That's a really nice rally. And you can see that the buying pressure has been well above the selling pressure for quite a while. Now, if we look at the 1-month trend, it is trending downward slightly. So we'll have to keep an eye on this, see what happens. And what about the top ranked sectors? Now, if you remember from my previous videos, these rankings tend to move fairly slowly because they look out over a longer time frame than, let's say, equity versus safety or buying and selling pressure. But you can see how technology, semiconductors, are ranked number 1. That's a risky area to invest in. What about emerging markets, emerging companies? So these are all risk assets that are up here in these top ranked sectors. Technology again. So this looks really, really healthy. And you'll hear me say it again, I'm really happy cash isn't in this table. And what about the worst ranked sector? So this is the bottom section of that chart. that table. I don't put it all in one because it won't fit here easily in the slide, but you can see how cash is way down here. This is great. And Bitcoin is here. It moved up. It was in dead last not too long ago. Ark is moving up. It's up here. So you can see how, and then technology, the Qs are up here. So they're almost moving up into the top ranked sectors. This all looks really, really healthy. And if you want to get a little more of a leading indicator than looking at the pure rankings, let's look at how the rankings are either accelerating, so meaning their acceleration is more than 1 on this table, or decelerating, meaning their acceleration is less than 1 on this table. So you can see here that technology, semiconductors are way up here in number 2. We got emerging companies. We've got the Qs, technology right here, right behind Ark and Innovation. These are all accelerating upward in a very nice manner. In fact, if you look at consumer discretionary, it has an acceleration of 1.19, while consumer staples has an acceleration of 1, meaning it's going nowhere. So again, this is showing a healthy risk appetite. And cash, again, is down here. So this looks very, very good. And if we look at the Treasury markets over the last week, you can see how the longest duration Treasuries here, the purple line, when they go up more than the 20-year Treasuries, TLT, which do better than the shorter duration Treasuries. Now, if you look over the last week, the longest duration Treasuries were up the most. TLT was up second most, but you'll notice that the shorter duration Treasuries were all flat to slightly down for the week. Well, why is this? Well, the Fed came out and said that they're going to raise rates a few more times. Which end of this curve does the Fed control? They control the short end. So if they raise rates, that causes the price of these shorter duration Treasuries to fall. But the markets aren't buying it. Longer duration Treasuries are still moving higher. So this is going to be an interesting next month or so while we watch how this plays out. And how does that all show up in the buying and selling pressure? Well, these are at the shorter end of that duration. They're not really short, but they're closer to the short end. They're intermediate Treasuries. And you can see here how there's been a lot of selling pressure. And in fact, the selling pressure recently moved above the buying pressure. And you can see how the price has been kind of flat to slightly down here. So this doesn't look really good for shorter duration Treasuries, and I think that's mostly because of the Fed speak. If we go out a little bit longer in time, you can see that the buying pressure is above the selling pressure. You can see the price has been kind of flat, a little bit challenged here. But let's go to long Treasuries. Let's go to the 20-year long bond. And you can see, again, the buying pressure above the selling pressure, but the price is kind of running flat, maybe to slightly up. So how does gold look? Well, you saw in some of my previous tables and charts how gold has kind of fallen off, and you can see that here. The price has been declining dramatically recently, and you can see that in the selling pressure and how it's shooting up here. In fact, if you look back over this time, as the price of gold was going up, the buying pressure was declining. So we had a pretty good divergence here, and you can see how that has turned out. Now, if we look at Bitcoin, we also have a divergence. The buying pressure is declining over the last month, while the price has been increasing and is now kind of flat-topped. I'm not saying you should go short Bitcoin, but we'll have to wait and see how this turns out, because this could very well turn around and continue heading higher. There's no crystal ball here. Sometimes the best course of action when it comes to investing is inaction. Be a long-term investor by taking the long view. As I said last week, my advice is stay put, stay where you are, until the markets show degradation in the metrics that I've been presenting in all of these videos, and then it'll become fairly obvious. In the meantime, the equity and risk markets are performing very, very well. Stay put and enjoy the ride for now. I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.